Chinese economy is hurting badly. What does this mean for the rest of the world? Welcome back to China Uncensored. I'm Chris Chappell. Joining me today at the Oslo Freedom Forum in New York is economist and China expert Christopher Balding. He taught in China for 9 years, and now he's an associate professor at the Fulbright University Vietnam in Ho Chi Minh City. Thanks for joining.
Thanks for having me, Chris.
So China just posted GDP figures for its third quarter, and it's the lowest it's been in 27 years. What does it mean that the official figures are that low?
If the official figures are that low, it means the reality is that much worse. I think most economists in reality are looking at a GDP growth figure probably half that. Some are speculating it's even worse than that.
Well, so what does that mean?
That basically means that China is growing much slower, and we're actually seeing this across a range of activities. If you look at the consumer sector, which China is touting as the great growth hope, actually we're seeing in a lot of areas of the consumer sector declining growth. Car sales are down significantly. Car phones are down, or phones are down significantly.
Are these Chinese-made cars and phones, or like imports of Ford and iPhone?
So in the automotive sector, China actually makes most of its own cars. It imports relatively small amounts, primarily of luxury vehicles, but China actually produces and consumes most of its own vehicles. And so with the depth of decline that we're seeing in consumer durables like washers and dryers, refrigerators, air conditioners, cell phones, automobiles, and even the food staple pork, it's very, very difficult to see how, for instance, the consumer sector is growing strong enough to drive the Chinese economy towards a 6% real GDP growth figure.
So are these lower GDP numbers, whatever they may actually be, an effect of the trade war?
No, these are actually an impact from really Chinese domestic policy over the years. A couple things that we're seeing, for instance, are really high debt figures in households and corporate sector are really restraining a lot of purchases that people might be making. Again, if we focus on the consumer sector, Chinese households now actually have more debt than most developed countries like the United States, Japan, things like that when compared against household income numbers. And this is also impacting the corporate sector. We're seeing very restrained investment growth in China because even though credit is being pushed, there's been so much in previous investment of things that have been built, and now there's overcapacity in a lot of industries, in real estate, in other sectors, and so people are quite fearful to actually go out and invest if they don't believe it's a profitable project.
Oh, so this is not so much an effect of anything the Trump administration is doing as much as it is systemic problems with how the Chinese Communist Party has been managing the economy.
That's absolutely correct. Probably the most that you could say about the Trump impact, if you will, is that it would be the straw that breaks the camel's back. It's additional stress. It's absolutely not the driver. And again, just more sense and perspective of what we're dealing with. You know, you'll frequently hear that the trade war is driving this global slowdown in growth or in trade, and actually that's not correct, because this slowdown in growth, slowdown in trade is centered in China. If we look at Chinese trade patterns with all of its partners, everywhere from Germany to Australia, Indonesia, Thailand. So we're looking really at a very broad range of countries. Trade with those countries is down across the board. And this isn't just, inputs that might go into an iPhone that end up in the United States. These are products that are going to be end up in China. Iron ore exports from Australia to China are very slow. High quality machinery exports from Japan and Germany to China are very slow. So we're not just looking at a narrow range of goods where there's a trade slowdown with China and its partners, but really across the board, across a wide range of countries.
So because of the systemic problems within China, that's creating a slowdown in their economy, which is creating a global economic slowdown. Is that right?
I think that's much more accurate. If you look at the countries that are really experiencing some economic pressures, if you will, Germany being a good example, they've taken a significant drop in their exports to China, and that's having a significant impact on the German economy. That's not from the trade war. Germany does not export a lot of products to China that go through China, get processed, and end up in the United States. Germany is exporting a lot of high-quality chemicals, precision machinery, luxury automobiles, things like that.
I love German chemicals myself.
German chemicals are some of the best. Very different from Burmese chemicals.
Low-quality Burmese chemicals.
Low-quality Burmese chemicals. So we see this spillover, that this is impacting a lot of countries from all over Asia and all over Europe.
So if the Chinese economy continues to slow down, what will that mean for the global economy?
I think it's going to mean that there's going to be a sustained global slowdown as well. I'm not necessarily of the opinion that you're looking at a global recession in the classical sense. Typically speaking, global growth recession is considered if growth drops beneath, say, 2 to 3%. I think it is possible that you will see global growth drop beneath 2 to 3%, which some might consider a global recession. But we can expect that to, I think, continue for the next couple of years, for sure.
There's been a lot of talk about decoupling the U.S. economy from China. Would that protect the U.S. economy if there is a Chinese economic crash?
Well, one of the things that you've seen go on throughout this trade war is that actually U.S. trade numbers in aggregate have continued to grow at a relatively steady pace. There really hasn't been much of a change, and so everybody's saying, well, wait a minute, why are we seeing trade numbers into the United States grow essentially on trend? Well, the reason is very simple. As basically the increase in exports from countries like Mexico, Vietnam, Thailand, places like that, is being offset by the decline in exports from China. So basically all we're seeing is these Chinese exports move to other countries. And so basically we can expect this process to continue for the next few years. Just this week it was announced that actually Samsung has moved all of its production out of China. And so it's very big in Vietnam. They've been moving into India. Apple has supposedly set up manufacturing in India. And so basically we can expect this decoupling to continue for the next few years, for sure.
So over the years, many companies have really tried to get access to the China market, but it seems like these risks have been known for a long time. Why did they make such a push to get into the China market?
There was always this this mythical, if we can just sell one T-shirt to each person in China, you know, that's a billion T-shirts in sales. So whether it was T-shirts or financial services or automobiles, that was the focus. And for a long time, I think companies were willing to make those trade-offs because they were making a lot of money. They were kind of entering a semi-protected market. They were working with SOEs most of the time, investments of any significant size.
SOEs being state-owned
enterprises. And so these companies were making a lot of money. As things have changed for multiple reasons, the growth isn't what it is, there's surplus capacity. Under the Xi administration, the state has taken a much more central role in everything. I think companies have really begun to question the trade-offs that they have to make to be in the Chinese market.
And so is that a result of them changing or the changing situation in China with the economic downturn?
I think it's a function of both. You know, if you had confidence in the economy, you know, you could say, okay, well, there's a downturn right now. If you start layering on the factors of, oh, well, you know, now I have to hire some Communist Party bureaucrat just to hang out in my company all day. Now if I know that they're going to be stealing from me, and now I know that I'm still going to be asked for bribes and all of these other things, tariffs, concern about Chinese politics, it definitely, in aggregate, pushes companies to leave. We don't see historically in any country, we don't see companies choose to locate in a country or move to another country for any one reason, whether it's a tax break or politics, whatever it is. It doesn't happen for one reason. And so companies moving is likely a reflection on their overall confidence in China.
So the Chinese Communist Party has a lot of control over the economy. That's the whole point of a state-led economy. What do you think the next thing they're going to do to tackle this falling economy?
So the most recent rumors or news reports, take them for what they are, involve essentially more of the same. That they're going to increase local government bond quotas, that they're going to push investment. They've made some, it'll be interesting to see, they've made some concessions about opening up markets to foreign financial service providers. It'll be very interesting to see because as in China, they can change the rules and nothing changes at the end of the day. So it'll be very interesting to see how that plays out. I think what is notable is to me as I look at these changes, and what I see are, first of all, more of the same. Like increasing the local government bond issuance quota. That's basically just allowing local governments to issue more debt this year. We're in October and they've already exceeded the quota for the year, and so they're going to allow them to issue more. So it seems like part of it is more of the same, which is not a good recipe. And I think what is concerning is that they're still trying to fiddle around the edges as Rome burns, for lack of a better term.
What do you mean by that?
There are very large systemic fundamental problems with the Chinese economy, and they're just not dealing with them. And so, increasing the local government bond quota for the year is going to kind of put a Band-Aid over a gunshot wound. It's not going to fundamentally address the problem. And I think that is the problem that they just still don't want to face up to.
Well, you say they're doing more of the same. They've been doing this for years, and people have been saying the Chinese economy is going to collapse for more than a decade now, but more of the same has kept the economy working. So will this work?
Well, it depends on what you mean by work. I think one of the things is, I have a good friend that gave me this theory, which I've been increasingly leaning in this direction, is that as long as they continue increasing the money supply, debt, continue building things, even if nobody necessarily lives in those buildings, even if those office spaces aren't occupied, things like that. What their goal is they need to keep growth going. Well, to prevent any real risk to, their goal of, build, even if nobody's going to live there, they have to basically essentially begin closing themselves off more and more. Because that is going to lower the risk of debt problems, that's going to lower the risk of currency problems, okay? And I think that's what we're seeing within the Chinese economy right now. As that is their growth model, they have to continue doing that, and I think we're going to continue to see a further closed off China from the rest of the world.
And so if the Chinese economy does collapse, what does that mean for the Chinese Communist Party?
Well, I've always been of the opinion that I don't like to talk about a Chinese collapse or financial crisis for multiple reasons. But I think one of the most fundamental as to why I don't like that type of terminology is that the Chinese Communist Party, and to answer your question, the Chinese Communist Party has a very fundamental interest in making sure that there is never a financial crisis or significant economic problem. Their entire governance campaign slogan is on economic management. We will give you a better standard of living, and you have to accept these trade-offs. And so if there ever is a serious economic problem, it's probably not going to end well for the CCP. And so this tells us, and I think this fits pretty closely with what we see empirically, is that there is no bailout too big. okay? There is no check that they will not write to say, we'll just sweep this under the rug somewhere, we'll merge it into another company, we will set up a bad bank to buy out these assets, something like that, so that we can keep the plate spinning, so that we can keep it going. And so that tells us, you know, the analogy that I've heard is that they will be very happy to be essentially, the way I would describe it is North Korea with a higher level of income. And I think that seems to be more and more the way that the world is moving.
So what happens to the rest of the world if China can't make a bigger bailout?
Well, it depends on which it is. If it's within China, the world will probably say, that's your problem. Okay, we don't, you know, if it's a steel company, you know, in Heilongjiang, the rest of the world's probably going to say, okay, you know, hey, have fun with that. Okay, the real risk, and I think you are seeing real pressure in this now, is if there is some type of U.S. dollar denominated bond issuance that they cannot repay for some reason, and especially if it's some type of local government, because what that would do is that would cause you know, a lot of investors, especially those that don't pay a lot of attention to China, they think of local government as almost sovereign level debt. And so if some of these companies started being unable to repay their US dollar liabilities, all of a sudden you have bankers that would say, well, wait a minute, we're not going to buy those US dollar denominated Chinese bonds. All of a sudden, there's a lot of US dollar tightness. All of a sudden, they're going to have trouble buying imports. All of a sudden, it becomes a much bigger problem very quickly. And at that point, the world would take notice very rapidly, and it would cause, and it would put a lot of risk on the CCP.
Well, so what would that mean for your average American?
It depends. So with the flows that we've seen into from like U.S. pension funds into bond indexes that specifically buy Chinese debt and in U.S. dollars, it could mean that they would see some type of drop to their pension or 401k. That's a distinct possibility. Generally speaking, because it would probably be, you know, chaos in the markets, for lack of a better term. In reality, the amount of exports to China as a part of total GDP are not large for the United States, so it probably would not have as significant an impact as other potential major financial and economic events.
Well, thanks for joining me. That was absolutely fascinating.
Thank you very much for having me, Chris. Appreciate it.